Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
The financial year 2015 has been a great year for equity investors. As the country heralds into a new dawn under the new leadership of Prime Minister Modi, and as the macroeconomic factors turn positive, we have also seen decent returns being made by equity investors in Indian equity markets. As we move forward to the new financial year, we move ahead with a lot of optimism as far as the economy as well as the equity markets are concerned. Our three pillars of optimism continue to be very, very dynamic and very vibrant. The first one is the macroeconomic factors turning positive. The second is the non-linear events, which is a fall in the crude prices, as well as a very robust governance, as well as focus on growth led by infrastructure, railways, defense, and so on and so forth. The third pillar is the earnings growth, and though the March quarter earnings are expected to be tepid, we expect in the next 3-4 years earnings to be quite robust. As we move forward, in the near term also, our view is that the markets might continue to show strength. The triggers for the near term obviously are passing of a few important bills which are likely in this month in the session of the Parliament. We also expect the earnings upgrade as far as the country is concerned, and we believe that it's a matter of time before India's ratings are improved. And the most important thing, as we mentioned earlier, is the earnings growth. We also believe that the government spending, which was rather timid in the last financial year, should pick up pace as we enter the new financial year. With the fall in the crude prices, as also expectation of a slightly more robust taxation collection, we expect government spending led by infrastructure, railways, roads, defense to pick up meaningfully. This, along with a falling interest rate environment, should ensure that earnings growth trajectory comes back on track. We believe that that would be the biggest trigger as far as the equity markets are concerned. Thus, in short, from an Indian perspective, things look to be quite positive. From a global perspective, things have been a little volatile, especially earlier it was the Russian economy, and there was a wide swing in currencies with euro and British pound depreciating quite sharply. There were also concerns about stray countries here and there, including Greece. However, as we speak, things are starting to stabilize, and our view is that with a very easy liquidity scenario almost in all parts of the world, including Japan, China, Europe and US, money flow into Indian markets, both equity and debt, should continue to be robust. So even from a global perspective, things are looking quite good. In short, our optimism on the Indian economy and the Indian markets continue to be positive, and we would advise investors to continue to look at the Indian equity markets positively. Thank you and wish you a great financial year ahead. Happy investing and look forward to your support as always.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
What is a mutual fund and what are the benefits of investing in a mutual fund? Your financial requirements are likely to grow over time, and even though your income may grow at a steady pace, inflation will take its toll. Traditional forms of investments such as simple bank fixed deposits or investments in gold may not help you realize your dreams and goals. How do you derive the maximum benefit from surplus funds? How will your dream of buying a car, going on a holiday, or buying a house be realized? Mutual funds might be the answer. What is a mutual fund? A mutual fund is a collective investment tool that pools together money from many investors. These funds are then invested by a professional manager in various companies after carrying out considerable research. Mutual funds allow an individual to take part in the stock market without having to monitor its movements on a regular basis. The fund manager takes your money and invests in a wide range of stocks and fixed income investments or debt. With the technique of diversification, it is possible to counter market fluctuations and minimize risk. So, if a particular group of stocks in a portfolio does not do too well at a given time, there is a possibility that the loss is balanced or minimized by better performing stocks in that portfolio. Once invested, you are given units in the fund based on the amount you have invested. These units are easily redeemable, which means that you can liquidate these units simply and quickly. Net asset value, or NAV, represents the value of one unit of your investment after all fund management fees are paid. NAV multiplied by the number of units gives you the value of your investment. You can invest a lump sum or through a systematic investment plan. In summary, the benefits of investing in a mutual fund are professional investment management, increased diversification, liquidity, ability to participate in investments that may be available only to larger or institutional investors. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Hello everyone. Let me begin with the Monetary Policy Committee decision which voted in the favor of a status quo, and that was unanimous in nature. This was largely in line with market expectations. So what did change was the reverse repo rate, which was increased from 5.75 to 6%. So effectively it means that the corridor between the repo and the reverse repo, which was at 0.5%, now stands at 0.25%. Why was this required? Couple of reasons. A, the overnight rate, which is the rate at which the interbank transactions happen, had gone way below the repo rate and was trading at around the reverse repo rate. This could have meant an implied easing of rates, which is something which we believe RBI could have been wary of. Number two, there is an excess liquidity in the system right now, which we believe RBI wants to gradually drain out. Is it likely to completely choke the system in terms of liquidity? The answer is probably not. But I think this band or the narrowing of the band would effectively mean slightly more orderly movement, especially at the short end of the yield curve. The markets obviously were expecting a status quo, so the impact was fairly muted as far as the short end of the yield curve goes. We saw an yields increase marginally in the band of about 5 to 10